excited, man.
So we were talking about Valentine's Day.
Yeah,
So,
exactly.
so what'd you do, man? What were the plans?
Well, dude, it's a little
Did it
funny.
go as planned?
So, yeah, I guess it kind of did, So Valentine's Day for us, dude, like, we typically celebrate a couple days prior, me and my wife.
Okay.
And we started doing that actually a few years ago because a lot of the times when we were dating, we would go out and, dude, like, it was just always so packed, and like I kind of really like to like assess the situation and stuff. Like I don't like too many people around, so
Yeah.
like I'd rather just like let's go out to dinner or whatever. So we went Friday actually, so that's kind of what we did.
Okay.
We didn't do nothing too fancy, but
Where'd you go?
to Texas Roadhouse.
Okay. Okay.
Yeah, so I had a porterhouse.
So just you and the wife.
Yep, just me and the wife.
Nice.
And we got a babysitter, so we just
Okay.
kind of talked. Really. Communication, I think, is a key, So
Yeah.
I feel like sometimes when we're not working, we got to spend time with each other. And although sometimes it's not like getting huge gifts for each other and stuff like that, I feel like communication is going to be more important.
Yep.
But that's what we did Friday. And then Sunday, I actually spent time with my family, my parents, my brothers. We went to church. And after that, we went out to the park. So
Okay. Nice. So pretty good weekend overall.
Pretty good weekend, yeah, man, I'd say. And I hope everybody else had a great weekend. What about yourself, man?
So I told you this. So outside of here, doing, I do some sporting stuff. So I actually do some live streaming, and that was pretty much my whole weekend.
Yeah.
Just like any other weekend, to be
Okay,
honest,
cool.
So my son, he plays baseball. My daughter plays soccer.
Okay.
And they're just about going into high school age. So this weekend I did some streaming, kind of like what we're doing today. I did
Gotcha.
some live events.
Okay.
Hashtag or shout out to SportsStream Arizona. That is my network.
Cool, man.
Trying to grow it.
Yeah, no,
just
good for
like
you, man.
just like we're trying to grow this. So Saturday I did that. Then he had a basketball game. So my wife and I went to that, and then yesterday, no, we had the day off yesterday,
Yeah.
Monday, right?
You forgot about that.
I know. President's Day.
Yep.
Sunday, I was there pretty much all day from 9 a.m. until about 8 p.m.
Yeah.
Streaming all day. So, but what's really cool that I've started to do is involve kids in it.
Right.
So trying to inspire kids, to create content.
Right.
I'm a big believer of our youth. They consume a lot of content.
Of course, yeah. Nowadays, I mean, even with people not being able to go out as much, I mean, they consume more content now than ever before.
Yeah. So, in my past life, I worked for a company. It was all about creating content.
Okay.
And so I try to get my kids and inspire other, kids to create versus just consume.
Right.
So
They call it being the spectator or being the player. The player or
Yes.
the spectator. So
Yeah.
if you're the spectator, you're just
watching everybody else do
always
some cool
watching,
stuff,
right?
you
But
know?
you're never actually playing the game.
yeah.
And sometimes it's kind of nice to play the game too.
Yeah, it is. It is. But you also need to learn, right? And you
Yeah.
need somebody to teach you. So,
For sure.
so yeah, that was my day. And then yesterday, just around the house, let's see, we went grocery shopping. All the boring stuff, man.
But hey,
get ready for the week.
At the same time, spending time with the family, it sounds like. So
Yeah.
I mean, at the end of the day, it's family oriented, and I think that's what these days are actually all about.
Yeah. And this industry too, for both of us, right? Like, do you feel like you have a lot of flexibility to kind of come and go as you choose and be where you need to be with family?
Yeah, typically I do. So it just really depends. I think we have to basically create a schedule, and with that, I'm able to spend more time with my wife and my kids whenever I want to, kind of.
Yeah. But you have to have a schedule, right?
yeah.
Because you got clients,
Right.
certain times you got to meet with them.
Exactly.
Yeah.
Yeah, and I mean, there's certain times when we're working after hours, 8, 9, 10 p.m. or whatever, and
Yeah. Kids are asleep.
The kids are asleep, yeah.
Right?
But,
So, yeah.
exactly. They're getting ready for school and sleeping
Yeah.
into it, right?
Dad's still working, right? So,
Yeah, but at the same time, whenever we want to go to the zoo or something on a weekday or something, we could go.
Yeah.
I don't have to necessarily say, oh gosh, like I can't go at noon on Tuesday,
yeah.
but I might have appointments after that,
Yeah.
maybe at 6 or 7 p.m. But, we kind of have that, I guess, put together in a way where it kind of works for all of us right now.
Yeah.
But yeah, man, I guess,
awesome.
we talked a little bit about what we did on Valentine's Day. Now let's get back to the real estate, man. So.
Yeah, let's talk. So, hey, by the way, if you're just joining us, this is Ozzie Korn and Brandon Harwood.
Yep.
We're doing our inaugural podcast together. We are here at Academy Mortgage in Chandler Fashion.
Yep.
And so you can check us out. Here's our Facebook accounts. Ozzie, how many years of experience in real estate, Ozzie?
Going on pretty much around 7 years.
Okay.
I did my third renewal already, so yeah, 7 years. Just
Nice.
About. How about yourself?
Started in 2019
Okay.
in the industry, so I'm coming up on my second year.
Okay.
And as mentioned prior to this, I did some like leadership and management in a tech company.
Nice.
So I did that for 11 years.
Cool.
A lot of kind of managing and finance, related. So this was like a nice, easy transition to come and do
into it.
this. So yeah.
That's cool, man. And I guess that kind of leads us into what we're talking about today. And it's really about folks that are looking to, I guess, sell and buy. Like, I get questions pretty much on the daily on folks that want to sell, but at the same time, they want to rent. They might want to do something with their house, but they just don't know how to go about it. Or how it will be done. And I guess that's why we're meeting here today.
Yeah. So we got some topics that we kind of pre-set up, right?
Mhm.
Try to keep it interesting for everybody.
Of
though.
course.
Speaking from personal experiences, we've been through this on personal, accounts, but also we're in the industry every single day.
Exactly.
So we're trying to advise people, and really that's what this is all about.
Right.
Education is power. We want to
Right.
make sure that people, know what's going on in the market. It's highly competitive right now. In your
Very.
7 years, have you ever seen it as hot as it is right now?
No, not this.
It's crazy.
Not this much. Yeah,
It's
no.
crazy.
I mean, I was looking at somebody hit me up a few days ago and that they want to sell, and I saw what we purchased it at, or what they purchased it at, and what it was originally listed at. We went like $5,000 above list price, but they got all their closing costs paid for at the time.
Okay.
This was like back in 2015 or 2016.
That happens all the time now, right?
No, not at all. Right now, it's actually the opposite.
Yeah.
It's complete opposite. Right now, what's happening is we're having such a massive shortage of inventory, which means that there's not a lot of sellers out there, not a lot of houses for sale right now compared to the amount of buyers that there is looking to buy.
Right. So I was hearing some numbers. What is the, forget what you call it, but relating to inventory, how much inventory is out there right now? They can do it. They can equate it to like a number of weeks or a month or so of inventory.
Yeah, so right now we have less than like 15 days of inventory.
Less than 15 days of inventory.
So out of, let's say we have, actually, let me open up my screen right now.
Yeah.
So out of all the listings that we currently have, and this is active, under contract, pending, meaning that it's a combination of houses that are actually for sale right now and other ones that already are taken by a seller, by a buyer, by a prospective buyer that's under contract with a seller for this property. So right now we have 9,300 listings in all of our Arizona Regional Multiple Listing Service.
Okay.
So with that, if we go ahead and we basically just put our active listings, this is homes that are not under contract, it basically takes us to 4,300. So you just cut it in half.
Cut it in half.
Yeah, you just cut it in half.
So that 9,300, like, okay, that's not too bad, but
then
half of them are under contract.
Half of them are now. Let's go ahead and out of that. Now, I'm not saying that these are all single family detached yet, right?
Okay.
Meaning single family residents that have a garage.
Right.
You have
so
a
are
yard.
some of these like land?
This would include land, patio homes, townhomes, apartments, everything.
Okay.
Now let's just go to single family detached, which is the most, people buy that the most. Now we're at 3,097.
Wow.
3,097. We just cut that again. Right now, in kind of what you're doing here, what would you say your average price point is?
In Arizona, it's about, so a couple years ago it was about 250.
Mm-hmm.
It's gone up.
Yeah, for sure.
It's now about 275, 280.
Yeah. So let's say
and that's the loan amount, actually. So let me retract there for a second.
Right.
So that's the average loan amount. The average purchase price is going to be about 5 to 10% higher than that.
Exactly.
So
let's say that you're looking at houses right now, probably what most buyers are looking for, probably starting 250 price point.
Okay.
So we go 250.
Yeah, so you're going to show how many 250 or
250
lower we have.
Yeah, and let's say
so we were at like 3,000 single family.
3,097.
Okay.
Right now, starting at 250, Now we went to 2819.
Okay.
So we dropped like 300 or something, right?
Okay. So it's 300 above 250, right?
Exactly. And now let's go ahead and let's put a purchase price of 400.
Okay. Oh man.
We just dropped down to 877.
877 homes.
877 homes that are for sale right now. And that's not to include homes that have RVs, RV gates,
okay,
RV garages.
Right. People,
pools,
they have their things they're looking for.
Land.
Yeah.
It's just so tight right now.
Yeah.
Where buyers are not necessarily finding the house, or they might be finding it, but there's just so much competition that they have to go above and beyond to make it happen, right?
Yeah.
So like that just gives you an idea from 250 to 400, 877 options in all of. Let me see if I could get a kind of show everybody here. I don't know if you could tell there.
Yep. Okay.
But that's basically all of Arizona there.
Wow.
Like all of we're talking from Casa Grande, Eloy, Maricopa, all the way out to Tonopah, and all the way up north to New River.
Okay.
So we're talking a big area. I wouldn't say all of Arizona. I mean all of Maricopa County. I meant.
Okay. Yeah.
But yeah, it's just insane right now how much shortage of inventory we have. So right now, buyers have to be a lot more diligent and a lot more aggressive.
Aggressive, yeah. That's the key term, aggressive.
More aggressive. Back in 2015, it wasn't the best offer wasn't the highest offer. The best offer was the offer you could probably get accepted at the time because things were still tight. They were on the come up at the time. But now it's completely evolved.
Yeah.
So
yeah.
So and what are your thoughts on that?
And I'm telling you, man, I just like you, I've never seen it like this. So as you know, I bought my first home back in 2008, and that was right as things were coming to a crash.
Coming to the crash.
Yeah.
Right.
So we actually bought a bank-owned property back then.
Okay.
And within 6 months of owning that property, went from, we purchased it at $200,000. It went down to a value of like $110,000.
No way.
So my wife and I were like, what did we get ourselves into, you know? But, you know, the market came back around, you know, some things were put in place because really it was the mortgage industry that really, you know, caused that. And so now in the last couple of years, man, I've never seen it like this. And I'm talking to realtors all the time. You know, they're trying to get their offers, you know, to be the most, you know, attractive ones to sellers. And it's even come down. It's not even about paying over asking now.
Yeah.
Right. It's about giving more incentive, waiving appraisals.
Yep.
I've even got a couple that are paying seller closing costs.
Wow.
Paying seller closing costs.
I haven't gotten that one yet. I mean,
they're
pay
like,
above appraisal.
Waive appraisal, we'll go above, you know, escalation clauses, and we will pay the seller's closing costs, which is about $2,500.
Yeah.
You know, so think of it like that's even adding another $2,500 on the deal.
Yeah.
The deal.
Right.
And then you got, not to mention all the cash offers that are out there.
Yep.
We've got a lot of people coming in from different states. You know, Arizona is open.
Right.
Right. And so there's some states that are still very shut down.
Mm-hmm.
So we've got a lot of people who are selling in their, you know, I've got some clients that are moving from the Midwest that are coming out here.
Yep.
They've got a lot of cash, but is it enough sometimes?
Yeah.
You know,
especially after right now, like I had somebody I talked to from Chicago yesterday. He's looking to buy out here, and he's like, dude, it's been 9 days that we're like 3 degrees right now. It's snowing so bad. Like it's going to be 10 inches of snow tonight. I've been shoveling snow out of my driveway. I can't even get to work. Like he's just, this is my last winter here. Like I'm so fed up with this. And then other people in other states that maybe the taxes changed. They've increased. So,
well, I mean, we got to make up for the pandemic that just happened over the last year, right? So taxes, taxpayers have to make up for that, right?
So a lot of people have been affected by that, but it's caused the inventory shortage in our market where, you know, folks are wanting to come to here. Yeah. You know, we got a lot of things going on in our East Valley. You know, got things going on in the West Valley as well. Got growth. I think last I heard, and this might be more, 350 people moving to Maricopa County per day.
Oh, wow.
So
that's where all the inventory is going.
Right, well, it could be. You know, obviously that's part of it. You know, it's going to happen.
Yeah.
you know, with the growth, it's going to bring more people.
Yeah.
So,
Yeah.
and obviously with more people need homes.
Yeah.
It'll definitely increase the prices. So, I guess we'll
Yeah.
talk about kind of
We
the
got
first,
some topics.
Yeah.
We'll try to make it interesting, try to make it short and sweet for everybody.
Yeah.
Again, if you're just joining us, this is Ozzie and Brandon.
King AMC, what's up, brother?
We got some people tuning in on Instagram over here as well.
If you guys have any questions as well, just let us know. We're here to help. So, I guess the first thing is, you know, folks being scared that they're not going to be able to find a house. You know, let's say that right now you're looking at houses, you're seeing one or two come out every few days that are maybe good options for you.
Yeah.
You know, but they're getting snatched up so quick. So that causes you to be fearful of, well, hey, if our house sells just as quick, how are we going to get into another house?
Yeah.
So one of the first things I want to talk about is seller leaseback. So when basically what that is, and we've been seeing this more and more in our industry, is when a seller is looking to sell their house within 30 to 45 days, they want to close on it, with the contingency to the buyer that's buying their house, that they have to lease it back to them for a certain amount of time. It could be 30 days, it could be 60 days, it could be 90 days, or we could make it as long as it needs to be.
Typically, there's no seller lease back, but right now, we're seeing it.
Exactly.
Yeah.
Right now, we're seeing it. Now, if we're talking 2-3 years ago, we'd be like, what the heck?
Yeah.
Like, no, that's not going to happen.
No, this is my house. I want to be in this thing. Yeah,
exactly.
Yeah.
Like, this house is going to be mine by the time I close on it. But right now, especially with folks, like, let's say it is a family moving from out of state. Yeah. And let's say they got a job transfer and they got to be here by May or before May. They might be open to doing a lease back to you.
Right.
And let's say they come out, they flew out here, they looked at your house when it was on the market and it was in pristine condition. So it might make them more lenient to say, well, you know, I really don't think that this seller is going to not get out in the 90 days and that they're going to destroy the house in 90 days. I mean, it's now if the house was in brutal condition, I mean, it might be something different. Tenant occupied, maybe the tenant doesn't cooperate. So that might be something to be more alerted by. But there are buyers that are willing to lease the property.
Yeah. And it's actually kind of a thing that they, in this market, again, they have to abide by, right? They have to kind of allow that because sellers have a lot of pull right now. Right,
exactly. So what that will help with is, let's say, like I said, you as a seller, you're looking to sell your house and you want to buy. You are seeing houses out there every few days that are coming out that fit your criteria, but you're just not able to, because you would be contingent.
Yep.
Upon the sale, if you didn't do this, then, you know, it's not as likely your offer will be accepted with a contingency versus somebody that doesn't have one. So we could be more competitive whenever we are looking for a house for the seller, which is now the buyer, right?
Yep.
Does that make sense?
Yep. I'm tracking with you like a VCR.
All right, and if you guys have any questions on that, just feel free to let us know as well. But basically with that, what it causes is that it releases that seller's assets, which is their equity in their house. They might have $100,000, $200,000, maybe $300,000 that they have equity.
Because the close of escrow happens, right?
Right.
Deposit, you know, wire transfer, all that takes place in this scenario.
So you would actually have your house sold.
Yep.
And you're basically living in it for an extra 90 days, leasing it back from the buyer that purchased your house. It releases your assets. Now you're able to say, okay, well, I don't have a contingency anymore. So it automatically makes your offer more competitive to any other prospective seller. You now have cash to come in with, you know, and you've probably at this point already talked to a lender. And this is where I want you to come in and kind of share with us what you typically see as far as somebody that does a seller leaseback. How much money would they, like, they already closed, they got their money, now they found the house and they've already talked to you. How much money do they typically come in with? 5%, 10%, or what do you typically see?
Their next home?
To buy their next home, yes, after they've sold.
Yeah, so, I mean, typically, you can go in as little as 5%, right? And
as little as 5%.
Little as 5%.
So on a, let's say on a $350,000 property, let's see, I'm not that great at math. So we'll
About
just
17,000.
okay, about 17,000.
Yep.
If somebody has 150,000 in equity and they have to come in with 17,000 to their new house,
They got plenty of wiggle room to do that.
plenty of wiggle room, and they could also pay their own closing costs, which we're seeing that right now.
Yep.
Typically, we're seeing what for 350, maybe 65, 7,000, maybe in closing costs.
Yeah, 6,500. You know, depends on the time of year. You know, you got
Okay.
taxes. You got to sometimes pay 6 months worth.
Right.
You always got to pay your 12 months of hazard insurance. But yeah, on average, you want to save about 6,500 for closing costs.
Okay.
Maybe buy down the rate a little bit too. You know, the
right.
market's it's good right now. You know, so but maybe you could even get your rate even lower. So
Exactly.
yep.
So with that, buying a $350,000 house, kind of what would a payment look like? Do you have that option to do a scenario right now?
Let's take a look. So we got any questions, by the way, on your Facebook or Instagram?
Just
Have people, pop
just
any
saying what's
questions.
up. Just somebody saying what's up.
Pop any questions you guys have too. We got topics that we put up, but really, honestly, Ozzie, like we're just trying to get the word out there. Educate.
Exactly. We just want to bring knowledge out there because really, a lot of the times these questions are real. These are real things that families are going through. These are real problems and situations that folks want to handle and create to their benefit because they see the opportunity in selling their house. They folks, a lot of folks never seen $100,000 in their bank account, or 150 or 200. They see it in their equity, but they've never.
That's kind of a fictitious number.
It's a fictitious number until it's in your bank account.
Exactly.
So this is one of the biggest assets of most people's lives. So we want to make sure that whenever they do make the decision that they at least have some knowledge as far as how to go about it.
All right. So you're asking questions about payment, right? So
Right.
$350,000 purchase price.
Right.
30-year fixed.
Mm-hmm.
You're looking about principal and interest $1,499 a month.
$1,499.
Okay. And if
Okay.
you add insurance, anywhere from $50 to $75 for most homes in that price range.
Right.
And then taxes on top of that, depending on where you're living, East Valley, West Valley, you're probably looking about $120 a month.
$120 a month.
Right.
Okay.
So $1,499
$1,499
plus 75
plus 75
plus 120. So you're looking about $1,694 for your payment.
$1,694.
$1,694. Yep.
And this is without them buying out their mortgage insurance premium, right?
So you do have mortgage insurance on top of that. If you're
Okay.
only doing 5% down, which this scenario is, I think this is a 5% down. Well, it's a loan amount of $350. So really, this isn't like
So it would be a higher purchase price. It could potentially
it could be a higher purchase price. But yeah, you want to add mortgage insurance on top of that, and that's largely dependent on your credit score, your debt to income ratio, and your loan to value. Okay, so
got it. But hypothetically, that would be $1,699 with them paying that mortgage insurance.
hypothetically, yes. Yeah,
Okay.
which a lot of people don't know you can do. You
Exactly.
you can buy it out, which is one of the topics, we had just kind of talked about is buying out your mortgage insurance as opposed to paying it monthly.
Right.
Sometimes it makes sense to do it. Sometimes it doesn't.
Sometimes it does. It depends on if you're planning on living there long term or not, right?
Right. Yep. If you
Okay.
plan on refinancing in the next couple of years, you don't get that money back if you buy it out up front, especially if your home is now, when you refinance, doesn't appraise for that 80% loan to value, which is where you don't need mortgage insurance.
Gotcha.
Right,
Okay.
so,
It just really depends on person to person if they want to buy it out or not. But in this case, let's say they did buy it out. So they're essentially coming in with like, well, we said 17,500 plus another like $6,500 or something.
Yep.
Let's say
So
7,000.
$2,400.
So
Or
we're
24,000. Yep.
Okay. They buy out that mortgage insurance premium. Let's say it's another what,
It's
7,000 maybe.
Well, it's like a 1%. Is a pretty good rate from buying it out.
So let's just say
another
this one like
3,500.
3,500.
Yep.
So
you're
you're still under
28,000.
So you're still under $30,000 all in.
Yeah.
This is all in.
Yeah.
if you don't have to, like, if you get it at base, if you get it right on the money, you don't have to come up above and beyond appraisal, all that stuff, which you might still have to come up another $5,000 or $10,000 as a buyer. So let's say
that's what you want to keep that money for.
Let's say, exactly. Let's say hypothetically that they'd have to come in with 40,000 and they netted 150 or 170.
Yeah.
And their payment's going to be $1,699.
Right. And then you've got some emergency funds, right, that you can keep on the side.
Pay off that car.
Yeah.
That's a $750 note.
There are some out there, yes. Yeah. I see a lot of them. Like, come on, man. Yeah. You don't need 3 of those.
Yeah, exactly. It's like, whoa, now they just killed your DTI here.
Yeah.
But, yeah, so obviously $1,699, right now the average rent in Maricopa County, I'm not sure if you're aware, but it's $1,895.
Oh, wow. So I could own my own home and use the equity that I have instead of renting to buy something else, and for cheaper than what I would rent.
Right.
Yeah.
And this was $350 purchase loan amount. So that was what? That was around $370, around $370 purchase price, right?
Yeah.
And that would be to sell and lease back. So let's say you just want to move up an extra bedroom, or you want to, maybe even downsize. These are all options that you could utilize using your equity. So this is really just moving your assets around a little bit, right?
Yep.
And especially with the interest rates being so low, that's why you get a payment within that range.
Exactly.
Right?
Yeah. So let's jump to. I want to jump to the third topic on here. We'll come back to the prolonged escrow.
Yeah, sure.
But another way of doing that same thing is, let me move this out, is bridge loans.
Okay.
Okay. So
talk to me.
do you, when I brought up the term bridge loan, like, you ever used one of those in a transaction?
I've heard it. I've had buddies that worked with it. Well, I have not particularly used it, but
a lot of times, I mean, in most markets, you don't even have to do this.
Okay.
Okay. But it is something to give you a more competitive edge. Okay. So bridge loans, what are they? It's the ability to use your primary residence, okay, the equity that's in there, similar to what we're talking about with the seller leaseback, where you can close on the escrow and have your cash, but you've got this leaseback transaction that you're now dealing with. Similarly, you can use that equity, pull it out as cash. It's secured funds, okay, because it's from your primary residence, and immediately use that cash towards the down payment on the new home, towards what we just talked about, paying over appraisal, incentivizing a little bit more. And you make interest-only payments on that for 12 months until you sell your primary.
Correct.
Yep. So again, it doesn't make you contingent, which I think, again, is what we're always trying to educate people on, is those contingencies are the first things that, as a listing agent, you look at, right?
Yeah. Right now, I mean, well, obviously, if you have a cash offer, you're most likely going to look at it first.
Yeah.
Second would be conventional.
Okay.
And then third would be conventional contingencies. Conventional contingencies, and then a lot
even before.
Exactly. And then that's just because a lot of the times they just have more skin in the game.
Yeah.
Somebody that's willing to come in with a $10,000 earnest deposit is going to be stronger than somebody that's coming in with $1,500.
Absolutely. Right. So this bridge loan, again, kind of going back to the process, it's kind of like doing a cash out refinance.
Okay.
So you're pulling that equity out of the home. But then you're immediately going to use that towards the purchase of a new primary residence.
And paying interest only throughout 12 months while I sell my house.
While you sell your house. So it's a second lien on your current primary residence. But the nice thing is, because it's interest only, it's a much smaller payment if you have to pay principal plus interest.
Gotcha.
Right? So I've got a client right now, they're trying to take out about $130,000 out of their primary. They got a ton of equity, but they can't sell it yet. Okay, they want to wait, but they're trying to buy something new.
Okay,
so they're going to take about $130,000, and that payment's about $450 a month, interest only, right? And then as soon as they sell that home, it pays off that second lien that was put on there.
Gotcha.
But they're already in their new home by that time. Right? So it's a small, cost to get you a lot of money out of your current residence. And another option to what we've talked about for seller leasebacks. And the other ones that we're going to discuss. So bridge loans, and we've got a lot of banks here. So I actually broker those through some banks that are locally.
Okay.
And it's about a 2-week process. So it's not too bad.
It's not too bad. So in other words, basically, I take out money from my house. up to 80% of its value, right?
Yep.
And then from there, I can go ahead and use that money right away to start looking for a house.
Yep.
Right. So with that, the bank is basically telling me that I'm going to be paying interest only for 12 months.
Yep.
Meanwhile, I actually get that house sold. So,
right.
but with that, we would have to qualify for the 2 houses, right?
No.
No. Gotcha.
You just have to qualify for the interest only payment that you're
for
making.
the interest only, which would be in that, like what you talked about, it might be less.
And
or it
again,
will be
you
less.
might also hear, do a home equity line of credit. Okay, so some people might do that. Like, let's just pull cash out, home equity line of credit. You're looking at about 6 to 7% interest, and it's a principal and interest payment. So it's sometimes 3 times the size of the payment of going that option to get cash versus doing a bridge loan.
Gotcha.
So
that other one's almost like they're pulling your money out of your pocket, and this one seems like it might be more beneficial.
I mean, it's a bridge.
It's a bridge to get to the next.
It's a bridge to get to the next home.
Which that might be a great option for some of you folks that don't want to do that seller lease back. You might just want to say, hey, I don't want to go ahead and lease it, and have to deal with the landlord and all that. I rather just. I have the money to qualify for a bridge loan, which is going to be, you're going to need to be able to do that in your debt to income ratio and as well as with your income, right? So it's going to have to work out there, but it's an option that we could utilize for folks to be able to, take out money, and go purchase.
And be more, and again, it's all about being competitive.
Right.
So let's talk about prolonged escrow. We'll come back to that one.
Cool. Sounds good. So prolonged escrow is... seller leaseback, we went ahead and we were leasing back the property after we sold the property. And this prolonged escrow is actually not closing on the property. We're just basically making the escrow process longer. So instead of typically our escrows go anywhere from 30 to 40 days typically. Is what we see on average typically for most loans that are conventional FHA, VA. But with the prolonged escrow, we would essentially let any buyers know that we're selling this property contingent upon them giving us 90 days or 60 days to close on this property. The purpose that sellers do that is because they want to make sure that they can go out and start making contingent offers now.
Okay.
And being able to find a property within that 90-day time frame.
Right.
The downside to that is that your house hasn't actually closed.
Right.
So it can essentially
that buyer
fall
could
through.
Technically also back out or fall out for some reason, right?
They might lose their finances change. They could lose their job. Things can always happen. Real estate is it fluctuates so much. We don't know what's going to happen.
Interest rates shot up. That person once qualified.
Now they're out of the
higher interest rate. They're out of the market.
They're out of the market.
So at least at that price point.
Exactly. So those are things that are downsides to the prolonged escrow, but it is also another option. That's why I brought up the seller leaseback first, because with that, you actually close on your property. With the prolonged escrow, you haven't closed on your property. You're just making the escrow longer, but it does have a little bit more risk.
So why would somebody do prolonged versus seller leaseback? Like what?
A lot of folks. Well, actually, prolonged escrow, we were seeing that a lot more about a year ago.
Okay.
I'm starting to see seller leaseback a little bit more now.
Okay.
Yeah, and obviously it'll obviously shorten your pool of buyers a little bit, because not everybody's willing to do these things. Some people need to be in a house faster than 90 days or faster than 60 days. But with the inventory being so short, there's always going to be somebody that
it's got more pull than the other person.
That's got more pull than the other person. So what we were seeing is buyers that were doing prolonged escrow, they were throwing in contingencies.
Okay.
And like I said, contingencies are a little bit tougher to get accepted. Yep. However, if we have a contingency that the buyer on their house has already done an inspection, we already went through the appraisal process,
which is all stuff you can communicate to that listing agent.
We could communicate that to whenever my client, the seller, makes an offer as a buyer, we could explain that to that listing agent. Well, we've already went an inspection, we've already done the appraisal. We're just looking to find the right property. We could close within 90 days, or soon we could close sooner than that. We have prolonged escrow for 90 days, but we could actually close in. Now that we found this house, we could close in 30 days with this house, and your house has been under contract less than 90 days. The seller, you could close within 60 days, and then as a buyer, you could close with another 30 days or so.
Okay.
So at this prolonged escrow is a little bit more complicated than the leaseback, but it's still an option to do that. Now you would still have to be contingent if you do the prolonged escrow versus the seller leaseback.
Okay.
Yeah.
Okay. So now we talked about seller leaseback. You're seeing a lot more of those now.
Yep.
In the market. Talked about bridge loans,
Mhm.
kind of a unique, creative way
Yep.
a lot of people don't know about. Prolonged escrow.
Yeah.
And what about that fourth topic as we round out and kind of close out this,
Yeah, for
how to be
sure.
more competitive conversation?
Yeah. So a lot of people with COVID, things have changed for them. A lot of folks have gotten up to their neck with debt, credit cards, maybe they stopped working. And things have really hit the fan for them. So maybe they have a house, but they're maybe not even paying it. They have some debts that are coming along their way, and they don't know what to do.
Yep. Credit cards are starting to pile up.
Yep. And unfortunately, it's happening to a lot of people.
Yeah.
So we're here to collect your assets and help you obtain the maximum that you can from your house.
Yeah, we'd hate for somebody to walk away.
Exactly,
right?
because once you walk away, you foreclose on the house, and
You
now
lose all that equity.
you could have came out with $100,000 in your pocket.
Did you just say $100,000?
100,000, and you might come out with zero if you decide not to sell it because you lost it.
Yeah.
So a lot of times, what we're seeing is people that are selling, they're resetting, and they're waiting. They might sell right now. They collect, whatever equity they have in their house. It might be 50, 100,000, whatever they have. Collect it now before they lose it. They go ahead and they reset, start paying off their credit cards, rework their credit, because obviously if they're late on their house, if they're late on their credit cards, if they're racking up their credit cards, car notes and stuff like that, your credit's going to suffer.
Yeah.
So with that, we want to start repairing the credit. So now you have extra funds to go ahead and start paying that off.
Because people, just because you own a home doesn't mean you're in a position to sell it and buy something new, right?
Exactly.
Your credit, was good maybe when you bought that home, 6-7 years ago.
Right.
And it maybe has taken a little bit of a hit.
Exactly.
So you might have to do this option, but to know that's an option, right? And that you don't have to walk away. You can't just, you don't have to just sit there and do nothing.
Exactly.
With the market the way it is.
Yeah, and a lot of people are just, hey, meanwhile, just reset. I'm moving with my family. They already told me that I could move in with them. Actually, they're struggling too, so two will make it better.
Yeah.
At some point, if both families aren't able to pay off their stuff, and I feel that for a lot of folks that might bring some,
relief.
Yeah, because all this stuff is stressful. We got. It's not just me, but everybody, most people that have a home, maybe they have kids, they have a spouse, they have all these things that they worry about, and their bills are just piling up, and you don't know what to do. Well, it might be time to sell the house. A lot of folks want to say, well, no, that's the last thing that should go, but at some point, it might be the only thing that could get you out.
Yeah.
So that's kind of my take on that. A lot of folks have hit me up on that as well. Like I said, it's unfortunate that families are going through that.
I was talking with a client yesterday, and again, similar thing. This, COVID hit last year. I think she went on a furlough or something like that. Ended up having to file bankruptcy. Okay.
Ouch.
Still was able to keep her house. Okay, so there's a way to not have the house included in the bankruptcy. So she's able to keep the house. Able to kind of keep that equity that she has. However, she can't refinance for a period of time.
Mm-hmm.
Okay, there's a minimum waiting period that she has to go through. And if she were to sell, she wouldn't be able to buy something new. Okay,
Gotcha.
for, again, period of time.
For a period of time.
The shortest period is 2 years.
2 years.
Now, did she see that coming when she, bought the house 5 years ago and now she hears the interest rates where they're at? Did she see that coming, that she would not be able to take advantage of those interest rates?
Right.
No.
She
right?
did it, yeah.
So biggest thing I talked about with her is keep making your mortgage payment. Like, you got to keep making that. And a lot of people are hearing about forbearance.
Tell me
right?
about that, please, because this is what I hear, dude. Like, people are telling me, like, oh, well, I didn't pay my house. Like, can I refinance now? Like,
there's
no.
So
no.
Forbearance is not free money. It's not like, so at the end of the day, you're paying an investor for the mortgage that you have, right? And that's somebody who has their money in this market, which is the mortgage market, mortgage-backed securities. They're not just going to let you do that indefinitely.
Of course not.
Right? Because they're not getting paid. Now, they are getting paid to a degree. The servicer, so if it's like Wells Fargo and anybody who's servicing your loan, carries that amount for a period of time, right? But they're doing it, they're also getting some relief from the government as part of that. But if you skip payments as part of forbearance, those payments, for one, are going to be tacked onto the end of your loan,
of course,
most likely, right? And in some cases, depending on what agreement you set up with the bank, you may have to bring all payments current before you are technically no longer in forbearance. So if you skip 6 months of payments,
you have to pay that all back.
You got to pay it all back and get up to date. So that could be, let's say your mortgage is $1,000 a month.
Just for
to
sake
get
of conversation.
Okay. Yep, that's $6,000 that you have to pay. Right. And another mortgage payment usually, because that's around, you just got to make that monthly payment. Now you're current. Okay.
Right.
But you have to wait as little as another 3 months after being in forbearance of now making 3 on-time payments in order to take advantage of refinancing.
Gotcha. So you had to make up those 6 months plus the current month, which is 7.
Yep.
And then an additional 3. So it's a total of 10 months before you were able to possibly refinance after you went in forbearance for
So it sounded like a good idea.
Yeah, and you know what?
But if you don't, this is the biggest thing. And I had some neighbors of mine who, at first thought, hey, this is the beginning of the pandemic. Things are happening. Like, we don't know what's next. Like, finances, is the income still going to be coming in? Thought it was a great idea to go into it, but they didn't need to. They had some money set aside. If you don't need to go into forbearance, avoid it. Don't do it, right? It's not like it's, it's.
Well, see, a lot of folks, they could have taken advantage of the great interest rates.
Yeah.
Instead, they thought that forbearance was the route, and they went into the forbearance.
Yeah.
Like you said, maybe not 100% needing to.
Yes.
And at the end of the day, you're shooting yourself in the foot with that, because now you can't refinance and take advantage of maybe a 2.4 interest rate or 2.5, whatever the case may be.
That's right. You could have still great credit. Forbearance, the most attractive thing to people is that it wouldn't affect your credit. You could skip your mortgage payments. It's not going to affect your credit. However, it is reported on there that you're in forbearance, and the lenders that you may be reaching out to refinance are going to see that on there, and then they're going to require additional documentation. Are you now no longer in forbearance? Have you met the agreement that was set up with you and your servicer, whoever gave you that option? So
stuff, man.
So if you don't need to do it, don't do it.
Don't do it.
Yeah. If you need to do it, take advantage of it, but just know that there's going to be, I guess, penalties is the best way I can describe it, right? So
yeah, I mean, that's pretty much it, man. I mean, anything else you want to throw in there?
No, I mean, that's good. I think, let's see.
I don't even know how long we went, dude. I mean, we're thinking like 10, 15 minutes.
About 43 minutes.
Dude, we kind of went on, but.
So we'll break it down too. On our YouTube channel, which we'll also shout out, a nice little feature you can do is you can actually go in and break it down by chapter.
Okay.
So what I'll do is I'll break down by chapter the different topics that we covered, so people can just skip to a chapter and be like, I want to learn more about seller leaseback or prolonged escrow. Yep. I may not care as much about a bridge loan, although again, what is a bridge loan? I have no idea. So maybe I do want to know
exactly. Find out, and then we'll see.
Yeah.
But no, that's great stuff, man. I really appreciate you having me here. I'm really excited to see what, if we're able to help out some families with this. And
it's all about education.
Yep.
That's why we do this. That's why we're starting this, is we just want to educate people. And, if you reach out and you got questions, like, just know that it's at no obligation to do anything if you reach out.
Exactly.
Again, you got Ozzie Corn 90
Yep.
Facebook. Is that the easiest way for people to get in touch with you? Or
I mean, they could reach out to me through there, or Instagram is fine, or they could even call me or text me 623-332-3929 623.
Let's put it up here.
The tech guy's gonna put it up real quick.
623-332-3929.
3929. And there it is.
That's
cool. So yeah, if you guys have any questions, and then how do they reach you? I mean, in case somebody, one of our peoples maybe wants to sell and buy, and you know, they want to start really by finding out what their payment would look like, you know, as a hypothetical.
So again, you can find me on Facebook, Brandon Harwood Academy Mortgage. Either one of those should pop up.
Okay.
And then also you can reach out to me. Here's my cell phone, 480-269-0507.
Perfect.
So,
well, sounds good. Do we have any questions from anybody at the moment? If not, we'll just sign off.
let's take a look. So I'm going to go on my Facebook. Let's take a minute. Let's see.
Sergio, what's going on, man? Angel, what's going on?
Oh, I'm signing your Facebook.
You're
Let me sign out. So when can we tell people, do you want to do this again? When's the next time we want to do this?
Yeah, man. Shoot. I mean, a week or two, whenever you're available.
Yeah?
Whenever you're available. Yeah, we got some other topics. Today, I just want to talk about those specific items, but, I mean, there's a ton of things we could talk about. So.
Yeah. Let's see. I got one comment. This is going to grow. It takes time.
Yeah, for
right?
sure. For sure.
Okay, so I did get clarification. Thank you. I've got one of my partners helping. So Kurt Lucas, also here at the branch, they need the ability to carry both payments for the new home, current home, and the bridge loan.
Gotcha.
Okay, so if closing on new is prior to close of current.
Gotcha.
So that is kind of a key. So we could look at everyone's situation is different, you know.
Right.
So
again, their debt to income ratio is going to have to work
Yeah.
with it, of course.
Yep.
So, but yeah, I mean, anything else? Any?
No.
All right. Well, cool. I guess let us know if you guys need anything else. We're here to help.
Signing off, Ozzie Corn, Brandon
Let's do
Harwood.
it.